Hello everyone, welcome back to the channel. I'm Trading Co and this is the ultimate advanced price action course. So without further ado, let's get into the video. If you ever stared at a chart and wondering why did the price suddenly crash down from that random spot, here this is the random spot and why did the price fall or crash down. Today's video is your game changer. We are deeping dive into order blocks, the secret weapon of smart money traders that predicts massive moves. By the end of video, you will exactly know what they are and how to spot them in seconds and how to draw them like a pro. Stick around to feel the real chart examples and a bonus tip that could save you from fake outs. If you are new here, smash that subscribe button, hit that bell button. Let's level up your trading. Alright, let's jump in. Okay, first things first. What is exactly an order block? In trading, whether forex, stocks, crypto, indices, or whatever your poison, an order block is a specific price zone where big institutions, think of it as a banks or hedge funds, venture capitalists, etc., placed massive buy or sell orders. These aren't like your average retail traders. We are talking about millions in volume that create a block of orders that waiting to be filled. Why does this matter? Because when a price revisits the zone, it acts as a magnet. Here you can, let's say this is our order block and the price ended up actually coming to this level again, and after coming to this level the price will eventually rise to upside. What does it mean? Why does this matter? Because when a price revisits that zone, here this is the zone, it act as a magnet, either bouncing off as a support and resistance or exploding through it. It might reverse from here or it might explode but still give a huge move to either side. Now, sorry, it is the footprint of smart monies in smart money concepts or SMC trading. Picture this: institutions don't chase price, they set it. They accumulate orders in a tight range during consolidation. Let's Here you can see this is the tight consolidation and this is where the institution set the prices. First, they accumulate orders in a tight range during consolidation and then bam, an impulsive move to downside. This actually makes the move kick in as they unload or load up. This consolidation, this is your order block. This right here is your order block. There are two types of order blocks. Now let's talk about what are those. There are two types of order blocks. The first one is called bullish order block or called as BOB. The last bearish down candle as here. Okay, so this is for bearish block order for now. Let's say this. Okay, here we can see our red candle. Okay, now let's talk about it. The last bearish down candle before a strong upward surge is called as a order block. You can see here there is a tight consolidation and boom, a big surge to upside, and this will be the bullish order block. It's where the institutions bought big, creating future support. Now let's talk about bearish block. So the step one is to hunt for impulsive moves. Start with a higher time frame like 1 hour or 4 hours. So for now, let's go to 1 hour time frame and actually search for a big surge to upside. After we go to higher time frame to see the big picture, look for a strong directional surge. That's your impulsive candle or series of candles breaking out with high volume and little wick, showing conviction. No wimpy dojis here. Think 3 to 5 candles in a row slamming in one way. Pro tip: use 200 EMA to confirm trend. Order blocks shine in aligned trends. Here you can see we have found an order block. Here you can see that the 3 candles slammed to upside and then given a huge move to upside. So we will be drawing this as our order block and we will be waiting for the price to eventually get reversed from this order block or break through this. Step 2. Backtrack to the origin from the end of that impulsive rewind to the last opposing candle before the move started. Let's say here the move started, and this will be our previous candle. For a bullish surge, find a finer red candle or small consolidation right before the green ones take over. That's your bullish order block. Institutions for buying the observing sell orders. The same for bearish. Last green candle before the red dominates. Here you can see this is our last green candle. So we'll be drawing this as order blocks. Now step 3. Check for consolidation close. The zone should be a tight range, not a wild swing. To look for fair value gaps nearby for quick price skips, equal highs and lows, or inside bars showing order absorption, or look for volume spikes if your platform shows it. Institutions leave footprints. Ignore if it's too wide or choppy. That's just noise, not a block. Step 4. Validate and refinement. Does the price respect it later? You can see that the price did respect the order block. So to trade this, we will be going to lower time frame like 15 or 5 minutes to trade this respected order block. Here you can see that the price did eventually respected the order block. So we'll be taking entry with stop loss above the order block and target at swing lows or highs. Here you can see that the price ended up hitting the target successfully after a very long time. And now let's talk about the validation of that order block. This is the final step. Validate with refinement. Does the price respect it later? It does, and here this is the proof that it actually respected it. If it's old, then multiple support and resistance lines, bingo. Common mistake, chasing every consolidation. Remember, only the last opposing one candle before impulse counts, or the consolidation zone before the impulse move. Practice on 10 charts today, you will spot them everywhere. Now the fun part, drawing them we will use TradingView, which is free and easy, but this works on other brokerage like Zerodha, Kite, or other charting tools too. So grab your charts and let's do this live. Step 1. Set up your chart. Open a clean candlestick chart in your preferred index or and then preferred time. Here, let's say we have taken a 4-hour time frame in AUD JPY. Here you can see, okay, sorry, this is the previous one, but still let's go to lower time frame and actually find one sub order block. Here it seems, okay, here we have found one. Okay, we never found it. Let's find another one. Here it seems we haven't. Okay, here we have actually found a order block here. So the step 1, set up your chart, open a clean candlestick on your preferred pair time frame, add 50 and 200 EMA. For context, optional. This is kind of optional because you do not need EMAs to predict or to see the chart trend. You can just spot the trend. Here you can see the price is in downtrend and then consolidation and then upphase. It is simple to track the markets, and so you do not need to keep EMA if it's by choice, if you're forced. Now identify the order block zone. Locate that last opposing candle. Here for our opposing candle, this is our green candle, which is the last candle. So we'll be drawing this order block as this candle as our order block. And now let's go to step 3. Step 3 is a draw rectangle tool for that candle, and we have drawn it. So if it's a mini consolidation, draw for the whole consolidation. Let's say this is the kind of consolidation we are looking at. So what we'll be doing is that we'll be drawing that consolidation instead of just single candle. Now step 4, okay, we have completed the step 3, which is drawing the rectangle for that candle. And as I told you, if it's color for green, semi-transparent for bearish, and extend it right forward, and we did extend it and label it and click it as BOB for context, and take 30 seconds once you're dialed in. Pro hack: use Fibonacci tool inside the block for exact trends, 50 to 62 levels or golden levels. Quickfire: how to trade order blocks. Wait for price to retrace into the block plus confirmation. Example: pin fair value gap fill. Here you can see this is a fair value block and the price came to fill this block. Here you can see that the price did eventually fill the block. So what next? Next, look for a stop loss below or above the block, which should be tight risk, and the target should be order block or 1:2 risk reward. Stack it with break of structure for confluences, and find examples and then backtest it for stronger confirmations. For now, let's find some examples and trade with live examples. Okay, here you can see we have spotted a search move to upside. So, and this is our previous candle, which will be considered as order block, and we extend it, and you can see that the price ended up coming to this order block and got reversed. So when price reversed, we will be taking entry when the price closes above the order block with stop loss below and target at the swing high. And this is how we actually trade order block. And now let's talk how we trade if the block is broken. As you can see, we have spotted order block, so we'll be drawing this previous candle as our order block, and now let's extend it to the right. You can see this time it didn't reverse but broke into the upside and given a big move to upside after coming to the retest again and given a huge move. So what we do in this situation, we will be taking entry with here with stop loss below and target at swing highs, and you can see that the price didn't even came near to the stop loss. It just came inside the order block but didn't came near to the stop loss. And that is how we trade order blocks. And for now, let's find some examples for better confirmation and better understandings. Here, if you look closely, price given a surge to upside after this red candle. We'll be drawing this red candle as our order block, and price ended up coming to the block again and got reversed. In this situation, we'll be taking entry after the the price closes above the block. Here, this is our ideal entry with stop loss buffer points and target at this order block. Here you can see this is also an order block because the price given a big surge to downside in just a short time, and you can see this time the order block got failed and turned into a breakup block. You can see the price given a big move after breaking it to the upside. This indicates that whoever has the orders like banks or institutions have changed the direction, making the price to go even higher after the breakout, and the same thing happened here. After a breakout, the price given a big move to upside. Now let's find some another examples for better clarity. Okay, we have spot and order block for the sell side. You can see after this small green candle, the price given a big move to downside. So we'll be drawing this as our order block. Price ended up coming to this block again by acting as magnet, but this time it was so strong that price didn't even came inside the order block but just given a wicks to the block and got reversed. So in this situation, it is an indication that the price is very strong. You can see if you followed the first video, which is about candlesticks in our channel, you can actually see and actually predict the fall. You can see that the sellers tried to make the price go lower, but buyers rejected it and made the price go even higher, but sellers tried again and dragged the price here. And the same thing happens here. The buyers tried to pull the market upside but ended up getting rejected by sellers and ended up closing near the open. This indicates a huge selling volume, and you can see by after touching this order block, the price given a big surge to downside. This indicates there is a heavy volume and limit orders at this order block, and when price actually came with the body near to it, it got reversed to downside with huge momentum and volume. You can see from here the price got volume spiked and given a big move to downside. In this situation, we'll be taking entry at the rejection candle. This is our indecisive candle, and right after it we have gotten the rejection candle, and we'll be taking entry with stop loss target here with stop loss buffer points and near this wick high. It is important to keep target at this area because the buyers tried with their whole power to make the price get here. That's why it is important sometimes to keep the stop loss at previous attempts lower or higher. And that's all for this video. In the next video, we'll be talking about fair value gaps and mitigation blocks. And if you haven't checked our previous videos, make sure you watch them for better understanding and for better setups. The first video is about candlesticks, which we will be talking about how to read candlesticks and how to predict the trends and market direction with just candlesticks alone. And the next video is about support and resistance, which will guide you to whether you can take an entry or to sell. And the third video is about supply and demand. So don't forget to watch those three videos, and don't forget to check out our app called Trading Co, where you can actually learn all of this without any fuss. And don't forget to like and subscribe, and don't forget to check out our playlist, which is about Ultimate Advanced Price Action course, which we are talking about right now. And that's all for this video, guys. Hope you enjoyed it. Comment down below what part you didn't understand, so I will repeat the topic again for better understandings. And if you have any doubts, comment down below, and I will see you in the next video.